Hi, this short video is designed for clients of our Portfolio Builder and Cash Flow Builder service to help you understand with the recent tax changes what you should be doing with regards to limited company versus investing in your own name. Now, I want you to remember we're not accountants at the Insight Group, so we can give you our best advice based on what we know, based on us understanding the market, but the bottom line is we recommend you speak to an accountant, and we recommend you speak to an expert accountant. Successful property investing is about having a successful team around you. We are that successful team, that's why you've got us. My personal accountancy team, they're not owned by me, but the team I use will give you advice too if you like, and I'll explain that at the end of this video. However, 95% of the time it's relatively simple to work out what you should be doing. If you are investing on your own and your income by 2020 is going to be at £50,000 or less, then you should definitely be buying in your own name. If you're investing as a couple, and as a couple your income is going to be £100,000 or less, again you want to be investing in your own name. Now, as you buy more and more properties, that pushes your income threshold up. And generally, the properties we're buying on a Portfolio Builder or Cash Flow Builder, let's say the average rent is $600 a month, okay? And the average costs that you have with that property, the lettings agent, the maintenance, and the insurance, so that might add up to about $170 a month. That means that property is going to be about $430 a month added to your income balance. You can offset some mortgage costs, but we'll come to that later. So that means each property you get adds about another £5,000 per year to your income. So if your income is £30,000 employed income or self-employed income, your properties, the first four at $5,000 a year would be $20,000, would get you up to $50,000. If in a couple, one of you's earning $50,000 a year and one of you's not earning at all, then you could probably buy 10 before you reached this income threshold, okay? So you buy in your own name until you reach the threshold. Now, at that point, you can either continue buying in your own name, and if you're only ever going to buy another couple, you'll probably still buy those in your own name. But if you've still got 8 left to buy as part of your plan, then you'd go to the second phase, which I'm going to cover shortly. Okay, so remember, this isn't accountant's advice. I don't know your exact personal tax situation, but it's a general principle that 95% of the time holds true. Okay, now, if you're over that threshold, so that's over 50,000 of income personally, and the reason it's set at 50,000, by the way, is the government has said categorically by 2020-21 we'll be at 50,000 where the 40% tax threshold kicks in. They're moving that up and up to that level. So if you're going to be over 50,000 as an individual or over 100,000 as a couple, and the average properties the Insight Group buys for you are £5,000 per property adding on that income, but you're going to be over, then 95% of the time it's best to be in a limited company and to set yourself up in a limited company structure. So if you want us to sort that out for you, it literally these days costs £12 online to set up a limited company. It's very easy with a bank like Lloyds, for example, to set up a limited company bank account, and you're up and running. And my team will set that up for you if you want them to. But again, we're not giving you the advice. We're telling you 95% of the time this is the way to go. Now, what are the caveats? What are the things that are different? Well, there's so many scenarios, I can't cover every single caveat. But what falls in that 5%? Well, the thing that I want you to understand, if you build a portfolio in your own name, the real benefit of that is that when it comes to releasing, refinancing and releasing money, the money that gets released is tax-free, as you will know. But when it gets released into your bank account, if it's in your own name, it goes into your bank account. However, if you have a limited company, it's still tax-free to release it, but you're releasing the money into the limited company. That money belongs to the limited company. So now the limited company has that money. Now, when you're in growth phase and growing your portfolio, no problem whatsoever, okay? But when you get 10, 15 years, 5 years, whatever your plan is down the line, and you're wanting to release that money and live off it, if you're releasing it within the limited company, it isn't in your bank account for you to spend and go on holiday or live off. It belongs to the limited company. Now, what does that mean? Well, you can only take money out of a limited company as dividends if you've made a profit. So the rental profit you make, if you've got 10 properties by then and they're making you £20,000 a year, that rental profit you'll pay tax on at reduced corporation tax levels, which is great, and then you can take a tax efficient dividend to take that money out. But the releases aren't profit. So you can't take a dividend to take that money out because it's a release. It's money that's sat in the limited company, okay? You can use it to pay salaries. So if your income is going to drop in 5, 10 or 15 years below that 40% threshold, if you're retiring and your income's going to drop right down, then you may pay yourself a salary from your limited company with those releases. Okay, you will dividend from that limited company, you will dividend to yourself the rental profit when that income has dropped. So if you're wanting to take these releases in the future and use them in a tax efficient way, and that's only 5 or 10 years away, but then you're planning to live for another 30 years, you may take the tax hit in the initial 5 or 10 years while you grow the portfolio and still do it in your own name, knowing that your income in the future will be virtually zero or right down, and then having those properties in your name is tax efficient for the remaining 30 years of your investment. So that's the caveat where I might not use a limited company. However, most people I speak to who have got a great income say, do you know what? I'm probably going to work for another 20 years or 30 years, or if I've got other investments as well, so my income's going to be, or my pension, I've got my pension as well as my property, so my income's going to be near that 40% taxpayer threshold anyway, even when I retire. Well, then it is more tax efficient to be having your portfolio probably in a limited company. So that's the only kind of grey area where if your income is in 5, 10, 15 years when you finish the investment and you're just living off the releases, and if your income by then will have dropped right back down, you may ignore the limited company for now, being more tax efficient, and still do it in your own name, take the hit for the next 5, 10, 15 years, but then you get the benefit of it with those releases later. Okay, so I hope that makes sense. For 95% of you, that will help you work out what to do, whether it's in your own name or whether it's in limited company. Now, some people will say, well, I'm still confused, or I'd like to just get absolute clarity and definitely know. The challenge we've got is we can't give you that tax advice. We can look at your scenario and we'll use those rules I've just discussed and apply them to your situation. So we can do that. But this is a long-term investment. You know, if you're building a portfolio that's going to release you $40,000 a year for the rest of your life, let's say that's 30 years of releases at $40,000 a year, that's well over £1 million of releases. It's worth getting this right. So if you want some specific tax advice from a specific tax expert in property, we can introduce you to our accountant colleagues. Now, we don't make any money for doing that. We're doing it to make sure you get the right expert advice. They will charge £250 for a consultation. It's $200 to $250 depending on the situation. That consultation might be half an hour to an hour. Now, that might feel expensive. It feels like a cost. Take it out of your investment pot that you've given us. Just let us know that you've had to spend a piece of the investment pot on that. We'll just make sure when we're buying the properties for you that we make sure the numbers all add up. Not a problem. So it's not an extra payment you're having to make. But you'll need to pay it out of your bank account. It'll leave you just a bit less for deposits, etc. But it's worth paying. If you've got any doubt or you're not sure, it's worth paying because it gives you that peace of mind. Now, this shouldn't stop you getting on with being on our sourcing list. This shouldn't stop you moving forward with everything because, as you know, it takes 2, probably 3 months to get to the top of that list. So we've got that period of that 3 months to get this worked out. The sooner we work it out, the better, because then we need to get you a mortgage decision in principle, and we can get the right decision in principle, whether it's one in your personal name or whether it's one in a limited company, and we can't do that till we know how you're going to buy. But remember those rules, and remember clearly, if you're under the thresholds, buy in your own name until such point as you reach the thresholds. I hope that video has been useful. Remember, invest with knowledge, invest with confidence, create financial freedom. We're here to work for you. We're here to build you an awesome portfolio, and we're really looking forward to working with you. Thank you for your time. Speak soon.